So let's talk about the initial consolidation. So we have our market maker sell model in front of us. Now, this area circled in red is our initial consolidation. In a market maker sell model, we are going higher just to go back lower below the initial consolidation. So how does this initial consolidation start? Well, this is again a crude depiction of the initial consolidation. Now, the algorithm will hold price inside of a range for a certain amount of time. And the purpose for this is to allow liquidity to build up above the market in the form of buy stops and liquidity to build up below the market in the form of sell stops, right? Now, in some cases, we can have a drop lower beneath the initial consolidation low. And when we see a consolidation or equal lows that sits above a higher time frame array, so this can be in the form of an order block, fair value gap, a mitigation block, a breaker. So any of the arrays that you can see in price, when we see liquidity or a consolidation above this level, this becomes a very high probability level. We can also have a variation where the buy stops are initially triggered and the market will then turn to activate the sell stops and into our higher time frame PD array and then expand away from the initial consolidation. Generally, I prefer to see this type of move because as the market runs higher, this will trap breakout traders trying to go long above the initial consolidation high, who will then place their sell stops below the initial consolidation low. The stops will get tagged as the algorithm reprices into the higher time frame level, and this is where smart money will pair these orders with long positions and the market will reprice higher. If we combine time into this manipulation leg below the stops into the higher time frame array, we get a very high probability setup that will start our buy program higher. Inside of this initial consolidation, we want to look for small candles in a tight range after we've had a run on sell side liquidity. So generally the consolidation will form after we've already ran sell stops to the left. Ideally, we want to look for equal lows below the consolidation range. Below these lows, we will find a pool of engineered sell side liquidity, which will be used for exit liquidity for smart money later on. We can also look for equal lows in the form of the equal bodies. Again, there'll be engineered sell side liquidity below these bodies, which will be used as a drawdown liquidity once a sell program of the market maker sell model is initiated. So if we reverse this for the market maker buy model, where we have the initial consolidation here circled in red, the algorithm will reprice lower just to go back higher above the initial consolidation. So again, we start with the initial consolidation, where price is being held inside of a range in order for us to build liquidity above the market in the form of buy stops and below the market in the form of sell stops. If we see price hovering just below a higher time frame PD array, then it's likely for the algorithm to reprice above the buy stops and into that higher time frame level before repricing lower to start the initial sell program of the market maker buy model. Again, we can often see a run on sell stops first and then reprice higher to trip the buy stops and keying off a higher time frame level at a certain time and then reprice lower to begin the sell program of the market maker buy model. We look for small candles in a tight range after a run on buy side liquidity. Generally, after we have completed either a buy or sell program, a new initial consolidation will commence, which will be the start of another market maker buy or sell model. We look for relative equal highs, which will make up the initial consolidation highs, and engineered buy side liquidity will rest above these highs. That will be a draw on liquidity when we begin the buy program of the market maker buy model. We can also look for equal bodies, and again, a large pool of liquidity will be resting above the bodies of the initial consolidation. We'll be expanding more on the initial consolidation and how that will tie into the market maker models in future lessons. For now, the main takeaway is all market maker models will start with initial consolidation, and the algorithm will hold price in a range in order for it to engineer liquidity above and below the market. This is essential since liquidity is the driving force of the markets. Without liquidity, nothing will move, right? So I hope you found this one insightful, and I will catch you again in the next lesson. So let's talk about the market maker sell model. And we're going to specifically be focusing on the buy side. So essentially, this is the buy program inside of the market maker sell model. Now, the market maker sell model we look for in higher time frame bearish conditions. So if the higher time frame is trending lower, the market maker sell model will be a retracement higher and will generally either run stops or rebalance. Once the buy program ends of the market maker sell model, the sell program will commence to take price back below the initial consolidation. So it's very important for us to know what the higher time frame draw is likely to be. Generally, the best trades using the market maker sell model in a higher time frame bearish environment will be on the sell side within the sell program. However, we can still counter trend trade to the higher time frame within the buy program of the market maker sell model. So let's use this as an example. So this is the daily time frame and price is down here. And above the market, we have this sell side imbalance, buy side inefficiency, right? We are anticipating price to run higher to close this inefficiency and then potentially continue lower since we are in a higher time frame bearish trend. So we anticipate a buy program as the retracement leg of a market maker sell model. The algorithm will reprice to the sell side imbalance, and this whole retracement higher looks like this on a 1 hour time frame. So this is the buy side delivery in a smaller fractal of this retracement on the daily time frame. Prior to price reaching the higher time frame premium level of this sell side imbalance buy side inefficiency. So to put it into layman's terms, this move higher on the daily time frame is the buy program on the buy side of the curve of a market maker sell model. So we're going to focus on the buy program initially and see how we can capitalize on the movement higher during this retracement into the sell side imbalance on the daily time frame. So here we have our initial consolidation, and this is our higher time frame level. Now, this can be any higher time frame level. Again, it could be fair value gap, it can be an order block, a breaker, mitigation block. It could be any of the number of arrays that we can see in price. It's all dependent on what we can currently see in price at the time. Sometimes we are going to just have a run on liquidity where we have an old high to the left and we are repricing higher in our buy program to purge the liquidity above the old high, right? So there'll be buy stops resting above that old high. Smart money will pair short positions with the buy stops and then distribute their positions below the initial consolidation. If we see a higher time frame level which sits just above an old high where there are buy stops and buy side liquidity resting above, this is higher in probability that we are likely to see a market reversal and the end of the buy program. Because the algorithm is so efficient, it will always look to kill two birds with one stone. So the two main parameters that the algorithm is going to look to do is to seek liquidity and to rebalance inefficiencies. What you're often going to find is an old high that rests below an inefficiency, and the algorithm will often draw to this area, and it will serve you very well if you keep this analogy whenever you're looking for setups in the market. Now, let's focus on the left side of the curve. So from the initial consolidation low to the higher time frame level where we expect price to reach for, this is known as the BDR, so our buy side delivery range. This is our range of opportunity to hunt for setups before we reach the higher time frame objective and essentially the completion of the buy program. So the initial consolidation down here will be our point of origin. and we're anticipating price to go up to this higher time frame level. We should then expect a reversal and the initiation of a sell program to run the engineered sell side liquidity below the initial consolidation. Once we have identified our point of origin and we have identified our potential draw on liquidity on the higher time frame, we can then grade our buy side delivery range in 25% quadrants. This is what our fib settings would look like, and we would anchor the fib from the high to the low of the buy side delivery range. The initial consolidation will generally form in the lower 25% quadrant. Between the 25 and 50% quadrant, we will generally see our first stage of accumulation or a return to the consolidation. We're generally looking for price to do one of two things. Number one, it will either drop lower to rebalance an inefficiency left in the expansion leg that moved away from the consolidation. Or two, it will look to run sell stops or sell side liquidity. At the 50% level, we will generally see a measuring gap. A measuring gap will not be fully filled and is normally a reflection of the halfway point between the origin and the terminus. If we take a fib from our point of origin to the measuring gap and project one deviation higher, we should get the high of the BDR. If this overlaps with a higher time frame level and or buy side liquidity, this gives us a good indication that this is in fact a measuring gap and gives us extra confirmation that we are sat around equilibrium 50% the buy side delivery range. This will make more sense as we get into future lessons. Between 50% and 75%, we normally expect our second stage of reaccumulation. Again, we are looking to either rebalance an inefficiency below the market in the form of a buy side imbalance, sell side inefficiency, or we are looking to seek sell side liquidity in the form of sell stops below an old low or relative equal lows. We will see an explosive move higher from the final stage of accumulation and into terminus, which would be our buy side objective or higher time frame level. The reason the final leg is usually so explosive, this would prevent traders from entering the market on a retracement, and it also reduces the time for traders to close positions that are underwater. Let's look at the initial consolidation again, and we'll get into a little bit more detail of how we can use the initial consolidation to give us measurements on how high the buy program can reach. So this is our initial consolidation. We have our initial consolidation high and we have our initial consolidation low. Now, this is known as the consolidation range. If we take the consolidation range high and the consolidation range low, and we take a fib and anchor it to the high and the low, we want to get the midway point between the consolidation range and project half a standard deviation above the consolidation range high. These are the fib levels that we would use. 0 would be the anchor low and 1.0 would be the anchor high. We would then see 0.5 deviations of the consolidation range projected higher on our charts. Here's an example. We have our buy side delivery range. We've got our point of origin and our terminus already established, and we have already graded our swing in 25% increments. Now, if we take our consolidation range and we project deviations using our fib tool higher, we will get 7 deviations. This is again a crude example. It will not always look like this in real life. But for this example, we have 7 deviations higher, which comes quite close to our terminus. The midway points are the 0.5 levels that we have added to our fib tool. Now, how do we use this information? Swing points will often form around these deviations. So we can use these deviations to anticipate highs and lows inside of the buy side delivery range within the buy program. Now, as a bonus, we can also project these deviations out, and often you're going to find high probability fair value gaps that will overlap with these deviations in price. If these deviations overlap with the grades of our buy side delivery range, This is where we are likely to see our highest probability setups form. If we see a deviation that is above buy side liquidity, so say we have an old high to the left, and it's in close proximity to this higher time frame level, we have a strong probability of a buy program high. So from the initial consolidation, before anything has printed to the right, we can already reference using these deviations to project a theoretical terminus, which we can then use to grade our buy side delivery range. So we can identify the highest probability areas of where setups will form before price even prints. I will show you how this is put into practice in the final lesson of this series. We want to reverse all of this for the sell side of the market maker buy model. So I'm only going to concentrate on the market maker sell model from this point onwards, because this series will then get incredibly long and incredibly repetitive. So your homework is to go through your charts and look for market maker buy models and mark up your charts for your own studies. Thank you for watching, and I will catch you again in the next lesson. So now let's discuss the sell side of the market maker sell model. So on the right side of the curve, we have the sell side delivery. Again, we look for the market maker sell model when the higher time frame is bearish. In our last example on the daily time frame, we had this buy side delivery of the buy program rebalancing this sell side imbalance. We've seen that on the lower 1 hour time frame fractal with the buy side delivery on the left side of the curve of a market maker sell model reaching up into our higher time frame level. In this example was the premium high of this sell side imbalance. After price had reached the premium end and completely closed in the sell side imbalance, the market then sold off, reaching for the sell side liquidity below these lows. So again, on the 1 hour time frame, the smaller fractal is the sell side delivery of the market maker sell model. So once price had left the initial consolidation and our buy program was underway, offering buy side delivery to our higher time frame level, we then have a reversal known as a smart money reversal or an SMR. So what is a smart money reversal? It is a change in state of delivery. So the algorithm goes from a buy program to a sell program, or a sell program to a buy program. In the case of the market maker sell model, we are going from a buy program to a sell program to have a sell side delivery. In a previous lesson, we have spoken about the types of reversals. We have our type 1 reversal, where we run above an old high and tap into a higher time frame level. We then reverse, breaking below an old swing low. This is known as a break in market structure. The type 2 reversal is we have reached a higher time frame level. We have this high, which failed to go above its previous high, giving us a lower high, and then running back below swing low, giving us our break in market structure. The ideal reversal pattern we are looking for is a type 1 reversal, where we make a higher high and then break below an old swing low. For extra confirmation, we want to look at a correlated asset class, and we want to see an SMT divergence between the two. When asset 1 makes a higher high, we look for a correlated asset class to make a lower high. If they are inversely correlated, then we would look for one to make a higher high and its correlated pair to make a higher low. I would only refer to this type of reversal pattern if its correlated asset was showing an SMT divergence by posting a higher high. So let's look at type 1 in a little bit more detail. When we see a break in market structure after we have run a short-term high and rejected from a higher time frame level, we are looking inside of the expansion leg that broke market structure to see if we can see a fair value gap. Now, this is what it would look like on the chart, where we have an old swing high, which we ran through, sweeping the buy stops above this high, rejecting from the higher time frame level, and then running back below this swing low, causing a break in market structure. Now, this break in market structure is confirmed with this fair value gap. If this fair value gap is not present, we don't class this as a valid break in market structure. We don't have to close below this swing low in order for it to be classed as a valid break in market structure if we still have the fair value gap present. However, it is higher in probability if we do see a close below the swing low. When price runs through the opening price of this last up close candle that ran the buy side liquidity, this becomes an order block, and when its open is violated, we have a change in state of delivery. This order block and the change in state of delivery is confirmed with the presence of the fair value gap inside of the expansion leg that traveled through the opening price of this order block. The algorithm will then reprice lower to attack sell side liquidity or to rebalance an inefficiency below the market. So now that price has reached its higher time frame level, and we have taken out buy side liquidity in the form of an old high to the left, we can now start looking for targets on the left side of the curve. We know that our initial consolidation is going to be our likely draw since the higher time frame is bearish. The sell side liquidity will rest below the initial consolidation lows. This would be our initial terminus as a target. From the point of origin to the terminus will be our SDR, or our expected range for sell side delivery. We are anticipating price to go lower after the smart money reversal, and we are targeting the sell side liquidity below the initial consolidation. So just like on the left side of the curve, where we could grade our range, we can now do the same for the sell side of the market maker sell model. Again, this would be our SDR levels on our fib tool. We would anchor our fib from point of origin, which would be the high of the market maker sell model, to the initial terminus below the initial consolidation, and we would get a graded range of 25% increments. So how far below the initial consolidation can price go? Well, the initial consolidation would be our first target, but we can use calibration techniques to assess how far low we can go. Now, calibration techniques are going to involve a number of things. Number one, we look for pip range below the initial consolidation. And what do I mean by that? Well, if we have our consolidation range, or we have our consolidation high and our consolidation low, we want to look for pip range below the initial consolidation in increments of 5, 10, 15, and 20 pips. The second thing we want to look for is if a higher time frame level will be in close proximity to one of the pip range levels. Now, between 5 and 20 pips is generally a good target, or if a big figure level, so a 00 or a 500 level, sits between a higher time frame level and a consolidation low, we can get anywhere between 30, 40, and 50 pips below. Once the buy program is complete, we can start taking measurements to assess how far the sell program can potentially deliver price. If we take the swing low, which is the last swing low before the reversal, and we take the swing high, this is our manipulation swing that ran the buy side liquidity above this high and into our higher time frame level. Now this occurs after the final stage of reaccumulation, and it tricks buyers into longs. Like I said in the previous lesson, the market moves explosively in this direction. This is known as the manipulation leg of the smart money reversal. This will form an intermediate term swing with a short term high to the left and a short term high to the right. If we take the swing low to the swing high, and we project standard deviations of this swing lower, we can look for potential targets that the algorithm will reach for to complete its sell program. If one of these deviations aligns with between 5 and 20 pips below the initial consolidation, and it also overlaps with a higher time frame level, this is a very strong confluence of where the market may want to reprice to. 2 to 3 standard deviations of the manipulation swing is common. When these standard deviations also align with other arrays, this is a high probability of a distribution area. 1 to 2 standard deviations of the manipulation swing is also another good area to look for redistribution.
If we also take the first swing low after the smart money reversal and anchor a fib from its low to the short-term high, and if we project deviations lower, this can give us extra confluence, again, especially if it lines up with a higher time frame level and another standard deviation. We can also take the breaker swing and we project deviations lower. Again, this is another strong measurement to look for confluences and overlapping levels. I personally use this one quite often in my trading. So now we have our calibrated terminus, which aligns with a higher time frame level, a 5 to 20 pip range below the initial consolidation, and we've used the different swing measurements. We now have our calibrated terminus. If we now grade this from our point of origin to our new calibrated terminus, and we divide that range in our 25% increments, we now have a calibrated grading range. The first stage of distribution is likely to occur around the first 25% of the graded range. Around this area, we are also likely to see a breakaway gap, which is an unfilled fair value gap. We will get into a lot more detail in future lessons about gaps. Again, at the 50% grade, we are likely to see our measuring gap, which will be an unfilled fair value gap at the midpoint of the range. Again, this measuring gap will give us extra confluence that our calibrated terminus was correct. We will normally see our second stage of distribution around 75% of our graded range. This is known as the silver bullet. In the next lessons, we'll go into detail about how and why the silver bullet entry forms, and how we can utilize this to take an entry. Reverse all of this for the buy side of the market maker buy model. So that's your homework, is to try to find a market maker buy model and apply these concepts to your chart. So I hope you have found this one insightful, and I will catch you again in the next lesson. This is part 2 of the market maker sell model, discussing the sell side delivery on the right side of the curve. So from our last lesson, we have already discussed about the different ways we can grade deviations and how we can arrive at a calibrated terminus. Now let's get into a little bit more detail about the sell side delivery within the sell program. So we have already had our smart money reversal here. We had our manipulation leg, which ran the stops above our short-term swing high. We have keyed off a higher time frame level, and this has completed our buy program as we have reached terminus, so the buy side of the curve of a market maker sell model. We have witnessed a change in state of delivery running through the opening price of a bearish order block, confirmed with displacement, and our sell program has now been initiated. So in the upper area, after our change in state of delivery, we have our first entry, which is going to be our low risk sell. And this is going to occur after the change in state of delivery has been confirmed. Now, time is going to play a crucial role in this. The change in state of delivery will be confirmed with displacement and time, but we will get into the topic of time at a later lesson. So this is what our change in state of delivery would look like, where the buy program has completed its buy side delivery, and we have rejected the higher time frame level
and ran below the opening price of the last up close candle, which becomes our bearish order block.
Now, the low risk sell will be a retracement back into the order block, and then we would see a move lower as the sell side program continues. On a lower time frame, you will see a fair value gap inside of this order block. This will be a high probability fair value gap. It doesn't need to come in to rebalance that. It can often just key off the low to the opening price and run lower, leaving that fair value gap open. We can travel higher into the order block, but we do not want to see the mean threshold of the order block breached on a closing basis. We next have our break in market structure, where we've had a run on the sell side liquidity below the second stage of accumulation. This gives us our break in market structure. Again, we do not need to close below the low in order to have a valid break-in structure. On a side note, if we break below the second or final stage of reaccumulation, this is much more significant than smaller break inside of the manipulation swing that run stops. Often, traders will be far too zoomed in on a lower time frame and they're looking at the lows, and every low that gets broken, they're considering it as a valid break-in structure. You need to zoom out and look at where you are inside of the different stages of reaccumulation. The highest probability valid structure break is going to be the second stage or the final stage of reaccumulation. Again, the fair value gap found inside of the expansion leg that broke structure is going to give confirmation of the valid structure break. In this area, we will have our first stage of distribution, where we return to the fair value gap inside of the leg that broke structure, and we will mitigate at the breaker, which is the down close candles that rests inside of the final stage of accumulation. We then have a second structure break and then a continuation lower to seek the next sell side liquidity below the first stage of accumulation. After we have run the sell side liquidity below the first stage of accumulation, we will begin our second stage of redistribution on the right side of the market maker sell model within our sell program. We will run the sell side liquidity below the first stage of accumulation. And again, as a side note, there can be more than two stages of accumulation or distribution cycles. It all depends on what price is presenting at the time and what we can see on our charts. We again have a break in market structure. We return back up into a fair value gap, or we witness a run on stops above a short-term high, and then we mitigate inside of a distribution block. The distribution block will be the down close candles inside of this stage of accumulation. In this example, this is the first stage of accumulation. But like I said, you can have many different stages of accumulation, but the concept remains the same. We then continue lower to seek the next stage of sell side liquidity below the initial consolidation and ultimately to our calibrated terminus. The distribution cycle essentially consists of these four things. We run liquidity, we rebalance or we run stops, we mitigate within an area on the left side of the curve, and then we continue lower to seek liquidity. Knowing just this alone will serve you very well going forward. Essentially, this is the mechanics of how the distribution cycles work. Like always, reverse this for the buy side of the market maker buy model. Again, your homework is to go through your own charts and try to find an example of this in a market maker buy model. Thank you for watching, and I hope you found this insightful, and I will catch you again in the next lesson.
So, in this lesson, we are going to be discussing the distribution block and the accumulation block.
Now, before we begin, you wouldn't have heard this terminology before, especially if you're familiar with ICT concepts. I coined this term many years ago when I was doing research on market maker models. Now, since then, ICT has spoken about this concept, but the terminology has never been clearly defined. Now, the reason I've called it accumulation blocks and distribution blocks is because it's specific to which side of the curve of a market maker buy or sell model we are referring to. Essentially, they are inversion levels, but when we are referring to accumulation blocks, we're talking about arrays on the left side of a market maker buy model. And when we refer to distribution blocks, we refer to arrays on the left side of a market maker sell model. Now, what do I mean by that? Well, let's get into it, and I can explain this in a little bit more detail. So here we have our generic market maker sell model. When price is on the sell side of the market maker sell model, where we have the sell side delivery and the sell program is underway, and we've already witnessed a break in market structure. We have seen price retrace back up into a breaker to mitigate, and then we anticipate another stage of distribution. Now, what is happening inside of this retracement leg higher in our second stage of distribution? Smart money is buying the sell stops below the swing low on the buy side of the market maker model. So in this example, this is our first stage of accumulation. So smart money is buying the sell stops below that first stage of accumulation, and they pair those sell stops with long positions and offset those longs to the buy stops in the form of willing buyers above a short-term high. and or rebalance inside the expansion leg that broke below the first stage of accumulation. Inside of this area, once we have ran stops and or rebalanced, there will be another stage of mitigation where the previous longs in the retracement leg higher will be mitigated inside of old areas of accumulation on the buy side of the market maker sell model. And they will do this inside of the lowest down close candles. Remember, there can be one or more stages of accumulation, dependent on what you can see in the charts at the time. The highest probability setups will form in the discount end, so the lower 50% of the distribution block. Price can travel up and reach the premium end of the distribution block, and it will still be valid. Pairing this distribution block with a fair value gap on the sell side of a market maker sell model will give you a very high probability setup. So the consecutive down close candles inside of an accumulation stage on the buy side of a market maker sell model is where we will find our distribution block. We do not need to see a high, low, higher high like we do in the breaker. So it has slightly different characteristics to the breaker, although it is very similar, and essentially is doing the same job. If you are using the distribution block for an entry, since the market can retrace back to the premium high of the distribution block, it's best advised to place your stop above the premium high. We reverse this for a market maker buy model, where on the sell side of a market maker buy model, where we have a sell program underway, the highest up close candles inside an area of old distribution is where we would find our accumulation block. Again, smart money will mitigate previous shorts inside of the accumulation block. The high to the mean threshold will be the most sensitive area, but price can retrace all the way to the discount end of the accumulation block. If we pair this accumulation block with a fair value gap on the buy side of a market maker buy model, this is where high probability long entries will form. So your homework is to go back through your charts, and where you see a market maker model, look for old areas of distribution inside of a market maker buy model and old areas of accumulation inside of a market maker sell model. Extend the distribution or accumulation blocks to the right and pair these areas with stops or fair value gaps and see how many times you will find setups. So I hope you found this one insightful, and I will catch you again in the next lesson.
So in this lesson, we are going to be discussing the different type of gaps that we find within market maker models. So firstly, let's talk about the common gap. The common gap is the most common type of fair value gap that we will find, hence the name common gap, right? You can identify a common gap where we have price that runs in one direction, whether it's just buy side delivery, known as a buy side imbalance, sell side inefficiency, or whether we just have sell side delivery, which is known as a sell side imbalance, buy side inefficiency. Common gaps will fully rebalance. And if we are in a bullish climate, say for example on the buy side of a market maker sell model, after rebalancing, the premium end generally will act as support. Now, a common gap can be traded to many times. If we travel back below the common gap, then the discount end can act as resistance. The common gaps give us our true support and resistance within price action. Another type of gap that we see in price action is known as the breakaway gap. Now, generally, we will see a breakaway gap either partially rebalance or left completely open. And we will generally see this when price is in a hurry to move away from a price range. So in this case, we have the consolidation, and price fails to return to the consolidation, leaving this fair value gap partially open. This also indicates that the algorithm is in a hurry to reprice higher. After we see price break above this high, we do not anticipate price to revisit this area, and it should remain left open. So the breakaway gap is breaking away from a price range, hence the name breakaway gap. We also have a measuring gap. Now, we've briefly spoken about the measuring gap in previous lessons, and we know that the measuring gap is found at equilibrium or 50% of the entire dealing range. Now, again, measuring gap will either partially balance or it will be completely left open.
Since we anticipate the measuring gap to form around 50% or equilibrium of the dealing range,
we can anchor a fib from the consolidation low to the measuring gap and project one standard deviation higher. This would give us a measured move from the anchor point to where the measuring gap forms.
generally I like to anchor the fib high, in this case of it being on the buy side of the curve,
To the high of the fair value gap created. So in this case, it would be the low of the third candle that forms the measuring gap. We can also use the high of the first candle as an anchor point.
On the right side of the curve of a market maker sell model,
After,
we have a confirmed break in market structure, which, if you recall in the previous lessons, the fair value gap inside of the expansion leg that broke structure would confirm the structure break. Now, we want to see if price wants to fully rebalance that fair value gap and treat it as a common gap, or only partially fill it and move away from this area. The breakaway gap is confirmed once we break below this short-term swing low.
we then expect price to remain heavy and do not expect price to revisit this area.
Again, this also indicates that the algorithm is in a hurry to reprice lower. Again, as mentioned before, common gaps can be revisited many times. If a common gap is in fact confirmed with a full rebalance, when price finds resistance on its premium high and moves away from this level, we can expect the discount end of the fair value gap to hold as resistance if price should revisit this area. Another common gap will generally form after the breakaway gap, and the measuring gap will generally form after the fill of a common gap at 50% of the expected range. Now, there doesn't always have to be a common gap before the measuring gap, but if we do see a gap after a breakaway gap that isn't in line with our expected terminus, then I would expect to treat that gap as a common gap. I would anchor a fib to the swing high to the expected measuring gap. Generally, I would anchor the low of the fib to the discount end of the sell side imbalance, which is the high of the third candle that creates the measuring gap.
We can also anchor the fib to the low of the first candle that creates the measuring gap. You can use both levels to see if we can get a confluence of other arrays in price.
Now, this is not always going to give you the exact low once we project a standard deviation lower, but in many cases you will find that it does give you the exact low to the pip. When you really understand how these market models work, you will see that there's a lot of symmetry within price action. If one standard deviation from the measuring gap aligns with our other deviation grades, higher time frame level, and within a pip range target, then this is a very high probability measuring gap. We would not expect this to fill, and we can therefore adjust our stops accordingly. This also gives us insight if we are to enter another position below the measuring gap. Although your highest probability short entries would be located in the upper 50% of the dealing range from the origin high to the terminus low. Understanding the relationship between measuring gaps, common gaps, and breakaway gaps can give you an insight into where we are within the buy or sell programs. In some cases, you will find that this sell side delivery is a sell program in the retracement leg of a market maker buy model, where we clear the sell side liquidity below the first stage of accumulation, and we may key off a fair value gap and an order block in this area to send price back higher. Again, this is why it's important to know what the higher time frame draw is likely to be. If the higher time frame draw is buy side, and we have one leg that breaks two stages of accumulation, this can indicate that price has dropped quickly to run sell side, where smart money would pair the sell stops to accumulate more long positions to offset those positions back to buy stops at a higher price above an old high. If the higher time frame is bearish and we have one leg that takes out two stages of accumulation, then this indicates that price is in a real hurry to get lower and we are likely to see an extrapolated move to the downside. So blending all of these different things gives us the highest probability of being on the right side of the market and finding the highest probability setups. Now, generally, there will be another common gap that forms after the measuring gap, and this tends to form around 75% of the graded range. If we are to continue lower, you will often see price retrace to this common gap, and its discount end will act as resistance to send price lower. As a bonus, if we are in the sell program on the right side of the market maker sell model, we want to look at the common gaps on the left side of the curve. Once price runs through these common gaps, this creates a balanced price range, and we would anticipate these gaps to become inverse levels that would offer us resistance and keep price from going higher. Again, many times this will be the reason why a breakaway gap will form, because there is a balanced price range with a common gap to the left side of the curve. And this is also true with measuring gaps. Often, the measuring gaps will overlap at equilibrium of the dealing range. Now, when price is retracing inside of a fair value gap, there are a few things that I look for inside of this gap on a lower time frame, such as the consequent encroachment or the 50% level between the premium high of the fair value gap and the discount low of the fair value gap. I also look for volume imbalances and areas of where we have balanced price action or an area of redelivered rebalance. Your homework is to go back through your charts and look for examples of these concepts in both market maker buy models and market maker sell models. I would encourage you to log your findings in a study journal. So again, thank you for watching, and I will catch you in the next lesson.
So in this lesson, we're going to discuss the elements of time in relation to market maker models. Again, if you haven't gone through the academy already, or you're not really familiar with ICT concepts, this is going to be a little bit more difficult to follow. Essentially, the market maker models are running on a time element that blends with price. Now, specifically, we are looking at data points to the left side of a printed chart where we have the open, high, low, and close. Now, price will refer back to these data points inside of a window of time. When these data points align with time, the algorithm is going to deliver a set of instructions, which is essentially what a macro is. These instructions will be carried out and price will deliver in one of four ways: consolidation, expansion, reversal, and retracement, right? Now, let's take that on a weekly range, and let's say, for example, this is a 1 hour time frame. Now, there are various market profiles, and not every week is going to obviously pan out like this, right? Which is why it's important for you to be aware of where you are within the stage of market maker model. If you understand the higher time frame fractal, then you can pinpoint where you are within that price delivery continuum. Now, Monday, typically, we have a consolidation. This is generally where orders are building up above the market and below the market. On Tuesday, we will have a retracement back into the expansion leg where price will align with a data point, and ideally we are looking for this inside of a kill zone. When the data point and time align inside of this kill zone, the first stage of accumulation will commence. The output will be an expansion phase, followed by a retracement, again inside of another kill zone, where we will have our second stage of accumulation. On Thursday, typically, we can form the high of the week. Generally, it will happen during the New York session, and this is where we will experience our smart money reversal. The buy program for the market maker sell model will be complete. We will witness a change in state of delivery, and a sell program will commence. On Friday, we can see a retracement back up into the expansion leg created after the smart money reversal, and this is where we will typically have our first stage of distribution. We can normally see this in the form of a TGIF trade, where we can retrace from 20 to 30% back into the weekly range that has already been formed. On Monday, in this case, we do not see the consolidation, but instead we see a retracement back into the expansion leg after the first stage of distribution, and our second stage of distribution takes place, which is also our silver bullet. So when we can understand where we are within price delivery, it will help us to identify when we want to be in a trade and when we don't. Just because it's a Monday doesn't necessarily mean that it's going to be a consolidation day. Now, we can combine market maker models with our AMD cycles. which is the accumulation, manipulation, distribution phases of a buy or sell program. Inside of the retracement legs is where we will see our market maker buy models. We have our accumulation phase, the manipulation phase, and the distribution phase. Since price is fractal, we can have smaller market maker buy models inside of a larger time frame market maker model. On the opposite side of the curve, the retracements of where we expect distribution to form will be smaller market maker sell models on a lower time frame fractal. There are buy programs and sell programs running throughout the different time frames, and all time frames are linked. Again, we will see our accumulation, the manipulation leg higher, and then the distribution leg lower. So this smaller market maker sell model is inside of a larger market maker sell model. Since we are on the sell side of the market maker sell model, our highest probability entries will form inside of these lower time frame fractals. Again, this is why it helps knowing where you are inside of that price delivery continuum. We can also take the daily range and we can combine market maker models with the power of 3, for example. Now, again, there are many different daily profiles. As an example here, we're going to use the consolidation in Asia as our initial consolidation. We have an expansion leg outside of the Asian consolidation up into 12 a.m. midnight New York time. Price will drop below the 12 a.m. opening price inside of London, where the Judas swing will form. This is where we expect the first stage of accumulation to form. We are looking inside of the expansion leg that broke away from the Asian range to align data points, PD arrays, liquidity, and gaps. Again, if we think about the power of 3 in relation to a market maker model, the Judas swing lower is technically the sell program of a market maker buy model. We then witness another expansion leg after our first stage of accumulation into the New York session, where we may have a news embargo, say at 8:30, and we witness a retracement lower back into the expansion leg between the London session and the New York session. And this is where we expect the second stage of reaccumulation to form. Price will then quickly expand higher, reaching for our buy side objective. Generally, the high or low of the day will form in London close. If there is a news event in London close and we have not yet completed our buy side objective prior to the news release, then this is where the algorithm is likely to spool price. Once the buy side objective has been complete, we will see a smart money reversal and a change in state of delivery will take place. Now, we can combine the market maker models with the power of 3 and standard deviations. Now, what do I mean by that? Well, post 12 a.m. New York midnight, we're expecting a drop lower. That retracement leg lower is the manipulation phase, where we expect our first stage of accumulation. Now, if we take a fib of that manipulation leg and we anchor it from the high to the low, and we project deviations of that range upwards, we can get an indication of how high the buy program can reach for. In this case, we get 4 standard deviations. If we take our accumulation range and run fib deviations higher, and we get 2 deviations that are in close proximity to each other, this again gives us extra confirmation that the buy program is likely to complete at this level. Of course, we would have to have a higher time frame level to the left. The deviations alone are not enough for high probability. They're a guide, but we still want to look to the higher time frame and make sure we are keying off a higher time frame level. Now, if we take the accumulation range and we project deviations higher, this will give us our manipulation leg. The manipulation leg is where we can expect to find a retracement or a reversal after tagging a higher time frame level. Now, generally, the manipulation leg will run to around 2 to 3 standard deviations of the accumulation range. If we take the manipulation swing that completed our buy program and we project deviations lower, we can predict our distribution leg to terminus. The distribution leg will normally fill 4 to 5 standard deviations of the manipulation swing. Again, refer back to previous lessons where we can build a confluence of different projection points, pip ranges, and higher time frame levels. But 3 to 4 standard deviations of the manipulation leg and 4 to 5 standard deviations of the distribution leg will serve you very well going forward. Again, if you use this as a rough guide, you would be able to distinguish whether we are in a retracement leg or we are in a distribution leg of a market maker model. Of course, we can also apply this to the AM session, and inside of the AM session, between 10 and 11 o'clock, typically we will see our silver bullet entry form. Now, the silver bullet entry is something that ICT has discussed on his YouTube channel, where we are looking for fair value gap inside of the expansion leg, inside of the times of 10 a.m. and 11 a.m. New York time. This is where we are likely to see our first stage of accumulation. Now, we understand that inside of the stages, we are looking for smaller market maker buy models. If we blend that with the macro times that ICT speaks about, now again, this is a general overview because our main focus here is the market maker model. But I do get into more detail regarding the timing elements inside of the Academy lectures, more precisely the Academy 2.0. We can view the AM session as our accumulation cycle. Inside of the lunch hour, there will be another macro that forms where we can anticipate the second stage of accumulation. We can see a high form inside of the lunch hour where we have our smart money reversal. Now, at this stage, who has been making money in the market? It's been the buyers, right? After the smart money reversal, we're going to start our distribution cycle or our sell program to target the stocks of those buyers from the morning session. We can typically see our first stage of distribution at the end of the lunch hour. And again, our silver bullet zone between 2 p.m. and 3 p.m., we will have our second stage of distribution, targeting the AM session lows. Notice the timing and where this stage of distribution is occurring. Silver bullet zone. This is the original silver bullet. Now the penny should be dropping of why ICT has called those times specifically the silver bullet time. Essentially, he is talking about the different stages of accumulation or distribution which occur at specific times of the day, right? So thank you for watching. I hope you have found this one insightful. Again, we will be getting into a little bit more detail in the next lessons. Everything that I have taught throughout these lessons, I will be applying it to a real chart so you can see how it all fits together, right? In the meantime, please go through your own charts and specifically note the times of day where you are seeing these stages of accumulation forming. So again, thank you for watching, and I will catch you again in the next lesson. Now let's discuss the high probability entries that you can take in regards to the market maker model. So again, we're going to be concentrating on the market maker sell model. Now, the first step is to always identify where price is within the higher time frame market maker model. Are we in a higher time frame market maker buy model, or are we in a higher time frame market maker sell model? Now, most of your time when you're studying should be spent on understanding your higher time frame narrative, right? I'm not going to sugarcoat it. That part is not easy. It takes time and experience. And essentially, this is why I run a mentorship program. So I can show you how the market narrative is broken down. Now, it's not essential to join my mentorship program. I'm not trying to plug that here. But my point is, once you understand the higher time frame draw and you can understand and break down market narrative, finding the market maker models inside of price action is much, much easier to do. Once you have established whether you are in a market maker buy model or a market maker sell model on the higher time frame, you then need to establish what side of the market maker model you are on. Are you on the buy side of the curve? And has the buy side objective not yet been complete? And therefore, do we have room to travel higher? Again, understanding market narrative here is incredibly important. If we find that we are in a buy program for market maker sell model, what stage of accumulation are we in? Are we in the first stage, second stage, or even third stage relative to the dealing range? Have you identified a terminus in price where we expect the buy side delivery to complete at a higher time frame level? Or are we on the sell side of a market maker sell model? Price has already completed its higher time frame buy side objective and has a sell program already commenced. If you do find that you are in a sell program, then what stage of distribution are you in relative to the dealing range from the point of origin to terminus? Have you identified a terminus? And have you found confluence through deviations, grades, and a higher time frame draw to support your reason for entry? Which brings us on to step 2, which is identifying the higher time frame draw and liquidity. Once we've established whether we're in a market maker buy model or a market maker sell model, in relation to that model, what is the likely higher time frame draw? Is the algorithm seeking buy side liquidity above an old high, or is it seeking sell side liquidity below an old low? Or maybe there is a buy side imbalance below the market that the algorithm may want to reprice to, or maybe there's a sell side imbalance above the market that the algorithm is reaching higher for. Again, this is easier when you understand where you are in the higher time frame market maker buy or sell model. If we use this example and say that we are in a higher time frame market maker sell model and we are currently on the sell side of the curve, and above market we see a sell side imbalance that we anticipate that price will be drawn towards, we can expect a short-term buy program to rebalance. Again, I've gone through this example in previous lessons. To remind you, that buy program to rebalance that higher time frame inefficiency will look like this as a market maker sell model on a lower time frame. These red lines are delineating the imbalance. Now, I always recommend that when you are looking for entries, you use 3 different time frames. You use a higher time frame, which will be your draw. You use a mid time frame that will set the stage, and your lower time frame should only be used for entries or placing your stop loss, refining it ideally, right? But your reason for entry should be based on your mid time frame, so your stage. The reason for this is because a higher time frame array will be stronger than a lower time frame array, right? The algorithm will reach for a higher time frame level over the lower time frame level. Again, traders are often too dialed in on a lower time frame and they forget the higher time frame draw or the higher time frame key levels. So now this is where you have to make a personal choice depending on the type of trader that you are. Are you a swing trader, position trader, scalper, short-term trader? Now, dependent on your personality type and what you are naturally drawn towards is going to affect the type of time frames that you're going to use, right? A position trader may use the monthly time frame as a higher time frame draw and the weekly and or daily time frames as the stage or the entry time frame. A swing trader may use the weekly time frame as the higher time frame draw and the daily or the 4-hour time frame as the stage and entry. A short-term trader may use the daily or the 4-hour as the higher time frame draw and the hourly or 15-minute time frames as the stage and the time frame for entry. And a scalper may use the hourly time frame as the higher time frame draw and the 15-minute and 5-minute as the stage and entry time frames. In this example, we're going to use the 4-hour time frame as our higher time frame draw. We have already established that we are in a sell program inside of a market maker sell model on the 4-hour time frame. We have witnessed the completion of a buy program to terminus, which is the premium end of the sell side imbalance. And we can see that here on the lower time frames. This could be a 1-hour time frame, for example. And we can clearly see the buy program of the market maker sell model. Now, for step 3, we have to wait for price to leave the consolidation. Remember, the consolidation starts everything. Once price leaves the consolidation in an expansion leg higher, we can expect price to retrace back into the consolidation. Our first buy entry signal would be found inside of the consolidation where we may have a fair value gap or an order block resting inside. As a bonus, the high probability order block will be found at equilibrium of that consolidation range. Now, sometimes price may not retrace back to the consolidation, right? We may get a breakaway gap. And again, I've explained this in a previous lesson. In this case, we could take an entry when price returns back to a fair value gap inside of the expansion leg that left the initial consolidation. Again, as a bonus, if sell side liquidity rests above the fair value gap in the form of a swing low, then this is a high probability fair value gap.
Again, depending on what your model is going to be, you can wait for a retracement back below equilibrium into a discount before you take an entry. But if you do find that there is a breakaway gap prior to the fair value gap that you were looking for, then we may not need to retrace back below into a discount relative to the dealing range. Dealing ranges have been explained in the academy. Similar to our second entry, our third entry can be taken when price returns to a fair value gap inside of the expansion leg that left the first stage of accumulation. Again, if you blend this with time and or sell side liquidity resting above the fair value gap, this will form a high probability buy signal. Now, after the buy program has been completed, and we have reached our terminus, which in this case is the premium high of this sell side imbalance on the 4-hour time frame, we can expect a change in state of delivery and a sell program to commence in order to attack the sell side liquidity resting below the initial consolidation of the buy program. There are aggressive entries that you can take for the sell program, and there are more conservative entries that you can take for the sell program. This is going to be down to personal taste and your appetite for risk. In my opinion, it is always better to wait for confirmation. So for step 3, we want to wait for price to reach that higher time frame level. If we have an old high to the left, which sits just below the premium end of that 4-hour fair value gap, this could be a turtle soup entry. Now, the concept of a turtle soup is just to enter a short position above an old high if we are going lower. As I have mentioned before, the highest probability turtle soups will happen when the algorithm is looking to kill two birds with one stone. In this case, it was looking to rebalance our 4-hour sell side imbalance. And if we have an old high with buy side liquidity resting above that high, which sits below the premium high of that 4-hour imbalance, this will be a very high probability turtle soup entry. Now, if you want to be extremely precise, and you have graded and measured the swing points within the market maker model and have found confluence with a higher time frame level and time aligns, you can enter a short position at the very high of the market maker sell model and catch the smart money reversal. Now, this is going to take some getting used to. Essentially, it is a turtle soup of a turtle soup. It is the very high of the buy program. If I am to trade this and I have a strong conviction and everything aligns, I will generally take a short entry over here, but it will be normally at either a quarter or half of my normal risk. I will reserve my positions with the highest risk after I have confirmation. And that usually happens after I have a confirmed change in state of delivery. We can take another sell entry when price returns back into the order block after we have confirmed the change in state of delivery. If we are pairing the SMT concept with a correlated asset, then this gives us a stronger probability of a change in state of delivery. Our fourth entry can be taken inside of a breaker which overlaps with a fair value gap. This is our unicorn entry. It's a very strong entry pattern, and once we have confirmation of a change in state of delivery, then this is a very high probability short entry. The final sell entry would be with our distribution block and our fair value gap. This is our silver bullet entry, and usually this is the most explosive and the quickest to reach target. If I could only trade one entry pattern with everything that I have discussed in this series, it would be the second stage of distribution in a market maker sell model, or the second stage of accumulation in a market maker buy model. If you get an entry over here that aligns with time, and we have sell side liquidity resting below the market, and we have a higher time frame level sat below the initial consolidation, and that also aligns with, say, 4 to 5 standard deviations of the manipulation swing, then this is a very high probability trade. Now, if we are in a higher time frame market maker sell model and the weekly expansion on the weekly time frame is set to go lower, then my highest risk will be taken on the sell side of the market maker sell model. I will still trade the buy side of the curve. I will reduce my risk in half since this is counter trend to the higher time frame sell program. Everything I have spoken about in this lesson, reverse this for the market maker buy model.
And like always, go back through your charts and record your findings in a study journal of all the areas where you could have found an entry inside of a market maker buy or sell model. As a bonus, look for the times of the day, days of the week when these entries form. So with that, I'd like to say thank you for watching, and I will catch you again in the next lesson. Welcome to the final lesson of this series. So in this lesson, I'm going to show you a real chart example. And I'm going to take all the information that we've learned in the previous lessons and apply them to an actual real life chart. Now, I have taken the euro dollar 15-minute chart here as an example, and I'm using the replay tool. This will be the best way for me to teach it, right? Now, I could have cherry picked something and gone for a really perfect market maker model, but in reality, you're not always going to find a perfect market maker model, as you are probably aware by now if you have gone through your charts and back tested, right? So this is one of the first examples that came up, and it's on a 1 minute time frame. So this would be ideal for a short-term intraday trader or a scalper. Again, don't forget that price is fractal, so this can be applied to any time frame. Apart from time of day where we get into kill zones and stuff, everything else is going to be similar, right? So we have the 15-minute chart here in front of us on the euro dollar. Now, I am delineating this high as our old high. This is where buy side liquidity rests above this high in the form of buy stops. Now we can clearly see that the higher time frame is bearish. The likely draw is below these relative equal lows down here. Now, if you recall back to the previous lessons, I said that the market likes to kill two birds with one stone, right? Now, in this example, we have the buy side liquidity resting above this high, and above it, we have the remainder of this sell side imbalance here. So there's a little portion of that sell side imbalance left open over here. So this is going to be the buy side draw on liquidity. We're anticipating price to reach higher before it goes back lower, attacking the sell side liquidity below the lows down here. So what has already happened? Again, I'm not teaching the PD arrays in this series. So if you would like to know more about them, then please head over to the website and check out the academy. Now, you can clearly see how we have rejected from the rejection block, and then price has stayed above it. We've created a higher low with this candle, and we have found support inside of this order block. We can see how the candle bodies have stayed above the mean threshold. We can see price finding support, and we've already witnessed a break in structure above this high over here. Again, this is a part of the model found in the actual academy, so I will not be reteaching that over here. If we move over to the 5 minute time frame, this is where we can set the stage and we can get into a little bit more detail, right? On this time frame, it doesn't look like there's an imbalance in this area. This is why it's very important that you have the higher time frame levels marked on your chart, right? Now, there'll be buy side liquidity resting above these highs. This will be our point of origin, and our expected theoretical terminus would be the buy side liquidity above the old high, and as far as rebalancing that 15-minute fair value gap. We do not need to fully rebalance that 15-minute fair value gap. The low hanging fruit objective would be the buy side liquidity above the old high. If we zoom in onto this area, you can see how price ran the sell side liquidity below these relative equal lows and back into this down close candle over here, which is an order block inside of a higher time frame order block. The mean threshold level is being respected and price rejects from this level and we push up higher, reaching our terminus. Now let's break this down further. We have ran the buy side liquidity above these highs with this candle here. And then we have run the sell side liquidity below these relative equal lows with this candle here. This gives us our initial dealing range. We are observing this at the beginning of the Asian session. This gives us our dealing range high and our dealing range low inside of our initial consolidation. You can see how we've ranged back and forth. All of this range is inside of this dealing range high to this dealing range low. We have our equilibrium level, which sits at the midpoint between the dealing range high and the dealing range low. This is our initial consolidation. You can see the relative equal lows
At the dealing range low, this is engineering a pool of sell-side liquidity below these equal lows. At equilibrium, we find our high probability order block. After price has left the initial consolidation, we've seen an expansion higher with displacement and then a retracement back into equilibrium where we find our high probability order block. Once price has touched the order block, you can see how it's rallied higher and swept the buy stops above the old high. Now let's get into the 1 minute time frame. So this would be our entry time frame. We have our point of origin down here, and we have our terminus in the form of the buy stops above the old high. At this stage, the buy program is complete. Notice how we ran up into the consequent encroachment of the remainder of that fair value gap. And if you notice the bodies, they're stopping dead at the old high. The bodies tell the story and the wicks do the damage. In this case, the bodies are not willing to go deeper into the remainder of that sell side imbalance left on the 15-minute time frame. This is an algorithmic footprint telling us that price is no longer willing to offer any buy side. From the point of origin to terminus was our buy side delivery range, or our BDR. If you recall, the way we measure our BDR is we take the dealing range high inside of the consolidation to the dealing range low, and we project deviations higher. In this case, 1.25 deviations gives us a high of 1.08753. And we can see how we came very close to that level, which sat above the old high. So this would have been a fairly good target for us. Now, if you look closely, since price is fractal, we actually have a smaller consolidation inside of that larger 15-minute dealing range. If we take the manipulation leg, which ran the sell side liquidity to the left, and anchor a fib from the high to the low, and then project deviations higher, we get 2.5 deviations, gives us 1.08753. Again, the same level as the previous deviation that we had calculated. Now, notice this is between 2 and 3 standard deviations, where we are already anticipating a reversal. Inside of this range, I am looking at these two up close candles. From this range low to this range high would be our breaker range before the manipulation. If we take the breaker range high to the breaker range low and project standard deviations higher, we also get a deviation of 1.08753. So we have three different ranges giving us the same price level, which all align above a buy-side liquidity pool and a higher time frame level. We can also see how price has returned back into that breaker, which overlapped with our 5-minute order block and the equilibrium of the initial dealing range. This is where we find our first stage of accumulation. Notice how the bodies of the candles failed to close below the mean threshold of this breaker. We have also ran sell side liquidity and into a small fair value gap in the form of this buy side imbalance, which also nested at that equilibrium level. This stage of accumulation is also in a discount relative to this range low and this range high. You can see the high of this up close candle comes in at 1.08754, which is 1 pipette of the 1.08753 level that we had found confluence at. So just 1 pipette of the exact high. Of course, we'll be calculating our graded ranges and deviations before price prints, right? So our theoretical terminus would have been the buy side liquidity above the old high. We would grade the range from the point of origin, which would be these equal lows down here, to our initial terminus. To speed things up, I'm obviously showing you the printed range of that buy side delivery within the buy program of the market maker sell model. At 25% of the graded range, you can see our first stage of accumulation. Notice where we have our stage 2 of accumulation at the 75% level of the graded range. Notice the reaction from stage 2 to terminus. We have rebalanced this small buy side imbalance and rallied higher, completing our buy program into our terminus level. Note that when we left the initial consolidation, price never came back to fully close this level. This became our breakaway gap, which also rested around that 25% level. After the breakaway gap, we had a common gap that was formed. which was completely rebalanced when we had our first stage of accumulation. Generally, after a common gap is rebalanced, at 50% of the range, we have our measuring gap. You can see here how this buy-side imbalance has been left open. Since our buy program is now completed, and we expect a change in state of delivery for a sell program to commence, we now wait for confirmation. If you wanted to take a turtle soup above this old high and into the consequent encroachment of the remainder of that sell side imbalance on the 15-minute time frame, which also had confluence with our 1.8053 level, that would be perfectly acceptable. But if you want to wait for further confirmation, then you are waiting either for a structure break or a change in state of delivery. Our terminus has now become our point of origin, and our point of origin has now become our initial terminus. The range between our point of origin and our terminus on the sell side of the market maker sell model is our SDR, or our sell side delivery range. If we take the swing low to the swing high that ran the stops above our second stage of accumulation, this is our manipulation leg. If we project deviations downwards, we get a deviation price level of 1.08631, which rests below the equal lows. So as an initial terminus, this would be a good objective. If we take the breaker swing from this candle's high to this candle's low, yes, I'm ignoring that wick, but there were reasons, and that's beyond the scope of this presentation. If we project deviations lower, we get a deviation of 1.08633, again in close proximity to the last deviation, and again below the equal lows of the initial consolidation. So this again would be a suitable target. Now, for the sake of time, we can see how our sell-side delivery range had printed, taking us back below the equal lows and completing our sell program. But how did we get there? When price ran back below the open of this up-close candle, this was our change in state of delivery. If you notice the bodies, how the algorithm was just marking time by keeping price inside of this range. Now you would see this more noticeably on a lower time frame. The change in state of delivery happened when we ran through it here with the displacement below the opening price of this up close candle. We broke below this low with a down close, leaving the fair value gap in the form of this sell side imbalance, buy side inefficiency. Since we broke market structure with a down close and we had displacement in the form of this sell side imbalance, this validates the break in market structure. Price has traveled back up into that fair value gap, which overlapped with the tail end of this bearish order block. This would be our low risk sell entry. Now, notice how we didn't fully rebalance to the premium high of this sell side imbalance. That's because on the left side of the curve, we're looking at this buy side imbalance. You can see how we reprice to the premium end, since this whole range now becomes a balanced price range.
Price does not need to fully rebalance this sell side imbalance,
since there is a balanced price range below it. We now have a breaking structure below this swing low with a down close,
with a fair value gap that has been left inside the leg that broke structure.
This would have been a higher probability breaking structure, since we broke below the second stage of accumulation. We have swept sell side liquidity below this low, and then price has returned back up into this down close candle, which is our breaker. Inside of that breaker, we have this fair value gap in the form of this sell side imbalance. You can see how price has traveled higher inside of the fair value gap, rejecting from the consequent encroachment area and touching the discount end of the breaker. Now, why did we not see price fully rebalance this sell side imbalance? Because if you look closely to the left side of the curve, we have this buy side imbalance in the form of a balanced price range. So price did not need to return higher to completely rebalance this inefficiency, since we had a balanced price range below it and we had the discount low of this breaker. This is our first stage of distribution. We have ran sell side, we have run into a fair value gap, and we have mitigated all at the same time. We then have another break in structure with another down close below it. We have a small fair value gap that prices traveled higher and rebalanced. Again, notice the bodies. We also have this up close candle, which is our bearish order block, validated by this fair value gap. We also have this buy side imbalance, which now acts as a balanced price range and an inversion level. And you can see how price is respecting the discount end of that level over here. The body's again telling the story that it's not willing to go any higher. This is our second stage of distribution and would be our silver bullet entry. Price then really sinks lower, clearing the sell side liquidity below these lows. In this market maker sell model, there is engineered sell side liquidity below these equal lows. The algorithm then has repriced higher, sweeping the buy side liquidity above the old high and tripping those buy stops into active market orders. Smart money will then pair these orders with short positions. The algorithm will then reprice back below the initial consolidation, and the interbank traders will offload their sell positions that they paired with the buy stops up here and offload those positions to the willing sellers below the equal lows. After our high probability break-in structure below the second stage of accumulation, we have our breakaway gap, which is only partially filled here. We have a small common gap after the breakaway gap, which is completely filled here. And then below the common gap, we have a measuring gap, which has remained open. Notice how this measuring gap on the sell side of the curve overlaps with the measuring gap on the buy side of the curve. If we take a fib and anchor it from the range high to the measuring gap, and we project one standard deviation lower, the very low of this candle comes in at 1.08632, which is the same level that we get over here, 1.08632. Stage 1 and Stage 2 occurred above equilibrium of the sell side delivery range. We ran the sell side liquidity below this low, and we ran the sell side liquidity below these equal lows over here. Now, this was a very shallow sweep, so there's still a large pool of liquidity resting below these lows, and the bodies of the candles haven't traveled below this low. Usually when this happens and we've had our stage 1 and stage 2 in the upper 50% of the range, this usually indicates that price is going to probably go lower. We see that we have a common gap that has again formed after the measuring gap. The candle's bodies are staying below the consequent encroachment of this gap. If we look to the left, this last down close candle on the buy side of the market maker sell model becomes our distribution block. And again, you can see how we're mitigating inside of this distribution block, inside of the common gap that has been formed on the right side of the market maker sell model. Ultimately, price rejects this level and rolls over in a series of 1, 2, 3 drives lower. If we go back to the initial manipulation leg and we anchor a fib from the low to the high and project deviations lower, between 2 and 3 deviations, we get a midpoint of 1.08600. If we take the very low of this candle, it comes in at 1.08601. So just one pipette off the actual low. And again, within 2 to 3 standard deviations of this manipulation leg. So when we blend all these things together, you can see how the market maker models can be extremely precise. Essentially, this is how the whole market is booked on buy and sell programs. A buy program will run into a sell program, and a sell program will run into a buy program. Tracking this constant ebb and flow of the market will allow us to search for the highest probability trade setups. We will be able to distinguish where we are inside of a buy or sell program. Using the range deviations, coupled with higher time frame key levels and areas of liquidity and inefficiencies, gives us targets where we can anticipate price to reach for. Again, understanding the higher time frame draw is essential when utilizing these market maker models. Understanding how we can grade a range and where our stages of accumulation and distribution may form also gives us a high probability to enter a trade. If we pair inefficiencies on the left side of the curve
with inefficiencies on the right side of the curve, we can often find the balanced price ranges, which will form dynamic support and resistance in the market. We can use our breakaway gaps and our measuring gaps to distinguish where we are within the accumulation or distribution cycle. Now, I know it looks relatively complicated, but the more you practice and go back through and journal, back test and study, you will begin to train your eyes in seeing these things in price yourself. There are always going to be slight variations between brokers, so the exact high and low can sometimes vary by a few pips. But if you stick to these principles, you can get very, very, very close. I will be going into more detail and doing many, many more examples throughout my mentorship program. Of course, I may or may not still be running the mentorship program by the time you watch this video. But if not, I implore you to go through your own charts, create a study journal, and really dissect each of these concepts in order for you to train your own eyes to see this in price. Remember, always try to keep 3 different time frames where you have your higher time frame draw, your mid time frame stage, and your lower time frame entry and stop loss placement. Everything that I have outlined in this example is directly taken from the lessons within this series. You may need to watch each video a few times. So with that, I would like to say thank you for watching. I hope you have found this series useful, and hopefully it has made the market maker models a little bit more clear for you. This has taken me many years of sifting through all of ICT's content to understand that this is what he is actually teaching us. So again, thank you for watching, and I wish you all the best in your trading career.